All right, ladies and gentlemen, this is the Fight Channel here, ladies and gentlemen. Got some investment news here, ladies and gentlemen. Bankers, investors are now betting that 2025 could be the start of another 1995, ladies and gentlemen. Let's listen to what they have to say here, ladies and gentlemen.
Portfolio for the rest of 2024. We've got good friend of the show, Sam Stovall, who is the CFRA Research Chief Investment Strategist. Thanks so much for taking the time here with us, Sam. So let's talk about that positioning off of the initiation of the Fed's cutting cycle and going into a period where earnings growth is really going to become challenged, it seems at least, depending upon how the macro continues to play out.
Well, you're right, and it's good to see you again, Brad. Basically, it's interesting, but wanting is more profitable than having. So it's essentially going back to 1990, whenever we had the last rate hike going into the first rate cut, the S&P was up about 18%. This time it was up more than 23%. Yet when we look at the first month's performance after the first rate cut, traditionally the market really goes nowhere, the benchmarks themselves. It's more the sector performances underneath where some of the defensive areas do well, but also tech and communication services come back into the forefront. We're still in the challenging seasonal period for the market. September and October are the two worst months during election years. But traditionally, we get that end of year pop after the uncertainty around the election itself has run its course.
You know, in your own research and as you're kind of lining up the strategy for the back half of this year, what type of allocation are you thinking is perhaps most demure, most mindful for a lot of the investors out there that are trying to figure out exactly how they navigate, not just through the initiation of a rate cutting cycle, but also through an event in a general election as well?
Sure. Well, first off, I think investors have to realize that the market was anticipating this rate cut for quite some time and bought up a lot of the tech stocks or the large caps in general, tech in particular, to the point where the S&P 500 is now trading at a 35% premium to its long-term forward PE ratio, and tech is at a 55% premium, but at least that's down from the recent 78% premium. The reason I mention this is because two areas look very attractive, mid and small cap stocks, because they're trading at 30% discounts to their long-term relative PE, meaning their own price to earnings versus the market itself. And while fundamentals tell you what, technicals tell you when and how far. And now that the Fed has started to cut interest rates, and there's a very good likelihood that we will have a soft landing, I think you'll find a lot of investors more willing to move into the mid and small cap areas. So that's what we have in terms of our allocation, a little increased exposure to mid and small caps. And depending on your personality as an investor, you know, I'm sort of a nervous Nelly. I like to wear a belt and suspenders. You might want to be going for those lower beta, higher quality oriented ETFs or stocks.
Look, I like a belt, suspenders. I'll put the wellies on too, and why not some waders as well at the same time, just to make sure you've got full coverage there for any type of environment we're wading through. All that considered here, what is the target you believe, especially coming off of all-time highs that we had seen at the close yesterday? I mean, the larger question that a lot of people are probably going to be talking about in some social construct or another this weekend is, do you think we can go higher from here? And what's the answer to that?
And the answer is yes, I do think we can go higher. You know that I'm a big fan of history. History is a great guide, but it's obviously never gospel. And we have just recovered all that we lost from the 65th pullback since World War II. And history tells us that once we do recover all that we lost after a decline of 5 to 10%, the market continues to advance for another 3 to 4 months, gaining at least 5% on average, before slipping into another decline or digestion of gains of 5% or more. So I think certainly that if we tread water or present a better buying opportunity in October, I do think that we'll get that end of year rally and then probably end up with a good January. And you know the old saying, as goes January, so goes the year.
Does that include an uninversion of the yield curve? Because you have those that will continue to call out the inverted yield curve to say that's one reason to potentially still be cautious.
Well, and I think whoever says that is correct, because there are a lot of historical indicators pointing to recession in the coming 12 months have been in existence for now 2.5 years. So does the boy who cried wolf get credit if the wolf finally does come? So an inverted yield curve, the leading economic indicators year on year declining, earnings recessions, et cetera, all of those things typically pointed to a recession, but we have yet to have it. Maybe this pandemic is sort of upending a lot of these old indicators. The uninversion, traditionally what happens is that the recession occurs after the inversion has reached its trough, and we have recovered by an average of 60 basis points, meaning the difference between the 10-year yield minus the 2-year yield. If the 10-year is higher by 0.60 or more, then usually that's the timing in which recession starts. But this time could be different because there's no guarantee we're heading for recession. We're looking for 2.7% GDP growth this year, 2.2% next year, and then 2% in 2026.
Sam Stovall, who is the CFRA Research Chief Investment Strategist. Sam, always a pleasure to get some of your time, your insights, and perspective. Thanks so much.
All right, ladies and gentlemen, very interesting here, ladies and gentlemen, on what he said, ladies and gentlemen. But let's get back to what we're here for, ladies and gentlemen. The start of a new rate cut cycle at the Fed Reserve has bank investors hoping for a return to 1995 age. That was the year the banking industry began one of the best run in U.S. history, following a series of new rate cuts from the Fed and soft landing engineered by then central bank chair Alan Greenspan. And I remember Alan Greenspan. I'm old. Index broad. Broadly tracking the sector finished 1995 up more than 40%, outperforming the S&P GSCP, and that outperformance will hold for more than 2 years. Could it happen again? So far, bank stocks are off to a good start. This year, the same banking industrial index that soared in 1995, BKX, is up more than 19%, just behind major stock indexes, ladies and gentlemen. Meanwhile, other indexes like the XLF, tracking the big banks along with other major non-banking financial firms, is up 21%, just ahead of major indexes. Interesting there, ladies and gentlemen. History isn't likely to repeat itself, but it may rhyme, like Mike Mayo, a Wells Fargo analyst who covered the city's largest bank, said in 1905. Comparison, Mayo isn't counting on next year being as good as that mystical year, but he does see similarities. That's the man they talk about there, ladies and gentlemen. Muggy looking guy there. On the three occasions, 1995, 1998, and 2019, where the Fed cut interest rate and a recession didn't follow, bank stocks on average sold off initially at the first cut, then rallied several weeks after outperforming the S&P 500, according to the analyst from Wells Fargo Securities. But a wider review of the past 6 rate cut cycle, including 3 that were followed by a recession, showed the industrial outperformance doesn't usually last long. Only in 1905 did bank rally more than a broad stock market for longer than 3 months. This could be only about 3 months, but we might have another rate cut in November, ladies and gentlemen. Who knows? And back then, it wasn't just monetary policy that lined up right for the banks. True on that. A rough start, ladies and gentlemen. Lenders actually started 1905 in a rough shape as major institutional buckled up. Get your seatbelts on, ladies and gentlemen. That includes the municipality of Orange County, California, declaring bankruptcy in December of 1994, and the British merchant banking borrowing, which collapsed in February of 1995. Banks with big trading desks were also still recovering from serious losses from the bond market wipeout the year before, and commercial real estate lenders were still loan loss from crisis that began in the late 80s, ladies and gentlemen. Remember, the late 80s had some very high interest rates during that time, ladies and gentlemen. I know I grew up during that time. My parents had to go through it. Meanwhile, Real USP GPA even slipped below 1% over the first half of the year, and the yield on the larger term 10-year Treasury plunged by 250 basis points. Wow, I didn't know that. Yet clearly these long-term yields remain higher than short-term notes that allow banks which borrow at short-term rates and lend at long-term rates to make a probably wider margin from the difference. Hello, who's the president there, ladies and gentlemen? That's Bill Clinton. He was in Mexico City on September 6th. What also helped banks in 1995 was the new period of loosening bank regulations, starting with a federal law signed by then President Bill Clinton the year before. You know, when Bill Clinton left, that was the last time we were not in a deficit, ladies and gentlemen. We were positive in our dang on economy. Now we owe over trillions of dollars, ladies and gentlemen. It's ridiculous what happened from then to now, ladies and gentlemen. That law eliminated restrictions that stopped banks from opening branches across state lines, setting the stage for a period of deregulation that would eventually give rise to country mega banks like J.P. Morgan, Wells Fargo, Bank of America, and Citigroup. Banks are largely having their way in Washington once again, while bank regulations have gotten more aggressive since the Trump administration. Big banks have more recently grown bolder in confronting regulators of disagreements. There's disagreement between regulators and the big banks, ladies and gentlemen. They want a big fix rate area this month when regulators watered down the new bank capital plan that would cut requirements for big banks by half from their initial proposal. It looks like the regulator pendulum may be swinging back that way, Mayo says. Not all moves in national capitals are to the bank liking, however. The Justice Department recently scrapped their own guidelines, improving bank mergers that have stood in place since 1995. That could be more bank mergers, or less smaller banks being around, ladies and gentlemen. That means the bigger ones will gobble them up. Dream or fever dream, ladies and gentlemen. For the time being, the expected impact of interest rates on bank earnings appears somewhat mixed. Lenders that benefit from higher rates are likely to see less profits. True on that, because they will have to lower that down before people can start paying off their loans, ladies and gentlemen. While those lag are expecting a boost. There's no argument that falling rates are good for banks. I'm not just sure that is the same reason that it was in 1985, said Alan Pulaski, Chief Investor Officer and CEO Portfolio Manager for Colbank Capital. A lot hinge on the ability of the Fed to nail its soft landing, keep the U.S. economy out of recession as inflation falls. But how much for do we need inflation to fall? We're just a little bit above 2%, ladies and gentlemen. Get that right. Our intention is really to maintain the strength that we currently see in the U.S. economy. Fed Chair Jay Powell told a reporter on Wednesday. I watched that, ladies and gentlemen. I mean, really good question they asked the Fed Chair there, ladies and gentlemen. Even without a U.S. recession, a repeat of 1985 will still require loan growth and a continuing viable investing banks. At the Barcade conference last week, some bankers that include Bank of America CEO and PCE CEO relayed that their expectations were better earnings in 2025. Better earnings for the banks? Their stocks go back up, ladies and gentlemen. Will you invest in them? I'm not into them slow-growing investments, ladies and gentlemen. Other than J.P. Morgan CEO told investors that analysts are a bit too optimistic about how much the bank will earn in 2025. That's very interesting there, ladies and gentlemen. Over the course of the quarter, our credit challenge have intensified. The CFO of Ally Financial said the bank retail auto business is the same day. And RBC Capital analysts expect banks to see higher revenue next year, but also more credit problems. Yeah, more credit problems because people, I don't know about that, but who knows? We do expect to implement higher loan loss provision in the next 12 months, in view by Cassidy added, ladies and gentlemen. But are we going to end up like we did in 1995, where we had a big boom for them, ladies and gentlemen? Who knows, ladies and gentlemen? Time will tell. Also, you enjoy this information I sent to you, ladies and gentlemen. Also, see you on the next one. Peace out, ladies and gentlemen.